Alrighty, everyone. Welcome to another episode of Portfolio Talks, where we're bringing the conversations around money right to you, at your fingertips, through your screen. And the days of you not knowing or understanding money are behind you because you're going to subscribe, like, share, all the fun stuff for Portfolio Talks to hear this episode and all the future ones. So today we are joined with Kalinka, who's actually in Brazil right now, which is really, really cool. We're just kind of catching up before we hit record, but she's doing that whole Canadian dream, which is a snowbird Canadian dream. And for those of you that don't know, that's like spending your summers in Canada, which is beautiful here. Get the mountains, the water, all that stuff. And then when the weather and the bad stuff about Canada happens, you take off and you're in Brazil. So before we jump in today's episode, which we're going to talk about insurance and how to protect your wealth. So now that you've built wealth, using insurance to protect it, Kalinka, how is Brazil?
It's awesome. It's amazing. It's hard to not say that it's amazing. It was a bit of an adjustment. We are 5 hours ahead, so it's the afternoon for me here. But other than that, it's awesome. Food, people, places we see. It's great. Yeah.
Have you gone to any football matches yet?
We actually watched yesterday. We went to see soccer, so that was a little bit of a difference. My little one was like, "Why is everyone screaming so loud?" So yeah, I'm a little bit behind with the teams and what's going on, but it was fun to watch. So yeah.
Amazing, amazing. So, what we want to talk about today is going to be wealth preservation. So, what is that, and then how can insurance help you with that? And I know Tyson, you've been in the industry for a long time, so you've probably seen so many cycles of this but from my experience, kind of what the first step, it was kind of opposite when we start working with clients. Their first step is I need to start building my wealth. So, doing my investments, maxing my TFSA, buying my first home, all that kind of stuff, and then I'll get insurance a little bit later on once I have enough money or cash flow for it. But in my experience, it should be the inverse relationship where you get your insurance first, at least foundational, and that's going to help you build that wealth. But what do you see when it comes to wealth preservation, insurance? What's like the philosophy that you see with clients and prospects?
Yeah, I think it depends on the culture that they come from. So when I deal with a lot of like Caucasian clients that are traditional, maybe fifth or sixth generation Canadian, um, sometimes when you say insurance, they cringe. Whereas when I deal with you and we're dealing in the South Asian market or we're dealing in the Asian market and we talk about insurance, it's a very different philosophy and acceptance of like, hey, we are actually doing this to protect our wealth. And it's also a dollar like arbitrage is, you're for pennies, you're getting dollars worth of protection for your family and for your business and for your overall plan. So I think it depends on the type of clients that you deal with. And so sometimes we have to undo some beliefs before we layer on the planning part. Um, but it is quite interesting. So for the clientele that we deal with a lot now is they're emerging affluent clients. And so they're young professionals, they're young business owners, and they're making a lot of money. Some of them have to pay down a lot of debt. They have a lot of startup cost. So what we want to do is we want to ensure their income. And kind of the story that I tell them is like, imagine if you came downstairs in the morning and there's an ATM in your kitchen and every day it spits out $1,000. Well, you would get used to that. Yeah, you'd cross your fingers, you'd kiss it and hug it in the morning. And then you also want to insure the ATM because you'd want to protect that from fire, from theft, from all of that stuff. You want to make sure it keeps paying you $1,000 every morning. Well, for these young professionals, that's you, right? You are the ATM. And so you want to make sure you're ensuring your ability to produce that income so that in the event that anything is interrupted. So for our young dentists and our young physicians and our young like RMTs, if you struck by lightning or something, I say struck by lightning because that seems to be the nicest way. If something happens to you, right? So you're struck by lightning, you can't work for 2 years. Where does all that income come from then? You want to make sure that it continues. And that's kind of like the foundation to the plan is we want to make sure the pipeline for all your goals and dreams in the future is taken care of. And then we could start to talk about some of the other things that would layer on top of that.
I agree. Yeah, I think when we talk about wealth preservation, it's important to think about where's that wealth being created. And to Tyson's point, it's from your ability to earn an income. And for the most part, you sacrifice a decade of your time to go to further education, or if you're a business owner, you've probably spent a decade like working 70 hours a week, making all the mistakes and all that kind of stuff to build up to finally now you're successful.
Hmm.
And when it comes to the wealth preservation, understanding where your wealth comes from is your income. So that's utilizing things like disability insurance to supplement your CPP if you're paying yourself CPP, or your EI, or even group benefits, things of that type. So I think that's always important to understand. And then utilizing insurance as well. So what happens if you get ill? You get paid out a lump sum of money via critical illness insurance. And then where do you pay that from? What happens if you pass away? Because the other thing that I noticed, Tyson talked about, two different demographics: people that have been here for multiple generations, and then people that are first generation wealth creators. We actually just had this conversation. I think Tyson and I had a joint meeting a couple of days ago. But it's important to understand that when it comes to yourself, if you're a first generation wealth creator and you haven't been here for multiple generations, you're most likely going to be the retirement plan for the generation above you. So perhaps your parents injected pretty much all their extra money into allowing you to go to post-secondary or helping you get established, and then they are going to depend on you to retire because they thought they needed X amount of dollars, but now inflation and all this crazy stuff that's happened, now they need this much, but they're going to outlive their money. So it's important that you understand that there's obligations that you may have that you don't even understand yet. So it's important to have the conversation. So when it comes to like wealth preservation, it's not just your wealth, but it's the generation above you and the generation below you. And I say that to say this, it sucks to have that kind of pressure, but at the end of the day, it is what it is. Pressure sometimes is a privilege, and you can put yourselves in a position to do that, but you need to be responsible enough to make sure that you're insured appropriately, and that way you can play a better offense because you have the defense taken care of with insurance. And yeah, that's kind of what I noticed. But Kalinka, I think for you it's probably a different situation because we think about wealth preservation on our side. It's a lot about the income and how you're generating the money. On your side, it's about actual asset protection because you're doing real estate, properties, commercial. What does it look like from insurance? Like the philosophy, how do people approach insurance when it comes to like their mortgages?
Totally. So we try to educate as much as we can, but also direct them to, of course, professionals like yourself who can educate them as well. And I think a lot of people are uneducated in this topic, of course, and I find more the younger buyers are less educated or they haven't even had the time to think about it. So opening up, the can of worms now in the sense of bringing up this topic to them, the sooner the better, right? So we do touch on the topic with them a little bit, and then of course we direct them to professionals who can deepen that topic with them. And as you were talking, Vishal, I wanted to bring a quick story up, which is something that's going on with a family member, a very close family member of mine now. So she had a great marriage. Her husband unfortunately passed away recently, and there was no plan set up, no wealth preservation, no insurance. And so not only the mortgage, but the debt and everything else that follows is on her laps now. So it's a very unfortunate situation. And it's something that, of course, I don't bring on the details, but I lightly sort of bring the scenario to clients to be like, hey, let's talk about it. Let's think about it because, everybody's trying to think positive and be positive, of course. And that, of course, we have to, but bring reality at the same time, prevent and preserve what we've built so hard and worked so hard for, so that not only us, but of course, the future generation, the little ones, especially if we have family, can also take great advantage of, right?
Hmm.
Absolutely, absolutely. And I think that's the important thing to remember is you would like let's say husband wife, you guys establish goals together. A lot of those goals are again predicated on your income, but also sometimes a lot of Canadians are leveraging debt to accomplish those goals. So whether you're refinancing a home to get cash and then doing an RSP catch-up loan, or refinancing debt to buy another investment property, or whatever, what happens is if, to Kalinka's point exactly, if one of those people are gone, think of like a business partner, half the income is gone, but now that person
Mm-hmm.
has all the debt. And not to mention, callable debts. Sometimes these debts are callable where the lender will learn that this person is now one instead of two. And like, you know what? We're not comfortable with the amount of debt that you have. We're going to call that debt back, meaning that you have to pay that debt back.
Wow.
And a lot of people don't have the cash on hand to do that. And you'll see this a lot in businesses. So if you have, let's say myself and Tyson, we're business partners and we have a business line of credit because we're expanding and we're buying books of business and we want to move to Brazil as well and all this fun stuff. If something were to happen, RBC for example could be like, you know what, there's only one of you now instead, so we're not comfortable with this debt. We want you to pay X amount of dollars back. And you kind of
Mm-hmm.
saw this in the mortgage industry when people hit thresholds. I think that's what they call their break point, trigger point.
Yep.
I heard so many different names. Whatever it is, it's the same kind of idea where the amount of debt has surpassed what the banks and the lenders are comfortable with, so they want to, rejig those numbers. It can happen with callable loans as well.
Yeah,
Scary.
absolutely. It is.
Um,
No, it really is.
Totally. So there's a lot of different types of insurance that are out there. So part of Portfolio Talks will have conversations about education, but we also want to educate you about specific things. So let's start, Kalinka, with you around mortgages, and then Tyson will switch and we'll talk about life, disability, and critical illness. But Kalinka, I know there's a bunch of different stuff you can get, but there's like creditor insurance, for example, when you buy a home or you refinance, there's paperwork that you guys kind of have to go over. What is creditor insurance and what's kind of like the basic? Because I think the worst thing that someone could have is nothing and opting out of everything and just like, it's okay, I'm gonna self fund this risk. That's the worst case scenario. The middle one is creditor insurance. Like, what is creditor insurance for people that have never heard that term before?
So are we talking about the Manulife? Is that the creditor
Yes.
insurance that you mean?
Yeah.
Yeah. So, of course, that's a form that we have to put in front of clients, but it doesn't have the coverage that, of course, you guys would be able to help our clients with. So, we would, of course, direct them to you, and so you would be able to go in depth and offer them, the coverages that they should be looking at and consider. And so, yeah.
Love it. And this is one question that we get a lot is conditions on mortgages. Sometimes they'll have insurance as one of the conditions, but it is not mortgage insurance. It is home insurance. Is that correct?
Yes, that is correct. So the clients are obligated to get home insurance to protect their home. So in case that there was a fire or something was to happen to the house, the lenders want to make sure that there is insurance on the house because of course they have great eyes on that property and interest on the property. So they also want to make sure that the house is insured itself.
Love it. And last question is when it comes to mortgages, there's CMHC mortgages,
CMHC.
which is
Yeah.
basically the bank again protecting their interests. I think you said that
That
perfectly.
only protects the lender. Yeah. So that's something that we always tell clients, and they think, oh, so now I'm protected. I don't have to get mortgage insurance. We're like, no, 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 no. So this insurance is a default, or you are required to have insurance, CMHC insurance, if you be CMHC insured, if you have less than 20% down payment. So that is an insurance that goes straight to the lender if anything was to happen to the mortgage. So if this client was to default on the payment, not be able to make the payment, the lender is insured, but not the client themselves. So we just like to separate it and make sure the clients understand how that works.
That is so well said. Default insurance. I don't think I've heard many
Yes.
people reference it as default insurance. And I think if we did, that would solve all the problems. That's like us calling it TFSA,
Right?
a tax-free investing account. It solves all the problems just by framing it differently. So if you're
Yeah,
watching this,
absolutely.
CMHC insurance is actually default insurance. And that was perfectly said. I'm gonna steal one more
Yeah,
thing from you. So I stole your
please
coffee thing. I'm gonna
do.
steal that. I'm gonna steal that as
Yeah,
well.
just that one small word in front of it can, cut a lot of explanation.
Totally, totally. Okay, awesome. Let's switch gears. So Tyson, we were talking about life insurance, disability, critical illness. There's so many different things out there. And Kalinka shared a story which is kind of like a life insurance story of someone that is no longer here and now their family's left with all the loans. How can life insurance solve that type of problem for someone in that situation?
Yeah, well, at a very basic level, what life insurance is going to do is replace the human capital. So if you're that high income earner and maybe you're the sole earner in the house, which we see a lot, um, you want to make sure that you're replacing your, or you have enough insurance to replace your income for a set amount of years based on the planning that you're doing. So, I mean, if you think about it, if you have young kids that are under 3 years old, and we've seen some households, they have three kids under 3 years old. Yikes. Um, and so you're responsible to raise those children, pay for their school, pay for their hockey, pay for their, for raising them. And that might be a ton of money. And you're also paying for the mortgage and the cars and the lifestyle, all that kind of stuff. So you want to be able to replace your income for that period of maybe 20 years. So you can buy life insurance for that replacement of human capital and all of your responsibilities. You can also utilize it just as a mortgage insurance replacement. So you have a $500,000 mortgage, you need $500,000 of life insurance so that in the event that something happens to you, your surviving spouse can choose to pay off the mortgage or invest the money and use the growth on the investment to pay the mortgage going forward. A couple of different ways that you can look at it. Um, and it's okay to have a portfolio of insurance. You might have one for the mortgage, and you might have one for replacement of your income, and you might have one for estate planning purposes. So say you're not a young professional, let's say you're an older professional, you're 55 to 60 years old, you're very, very well established, you have all of your wealth accumulation pretty much done. When that transfers to your surviving spouse and then to the next generation, there's going to be some tax implications when the ownership starts to change hands. And we use life insurance in those instances to cover the cost of the tax. So let's say, in BC, you bought a cabin. Um, you bought a cabin in Kalinka's neck of the woods up near Okanagan, right? And it was $100,000 waterfront property in 1991, and now it's like a $3 million, waterfront property. There's some capital gains going on there, and if you want to keep that property in the family, you have to be able to pay that. So you either go to Kalinka and you get a mortgage on that waterfront property to pay for it, keep it in the family, or you utilize life insurance to offset the cost of the capital gains so you can maintain ownership of the property.
Yeah, and I think another, again, if we talk about framing, I think a good thing to think about it is if your assets stay within your generation, you'll have something called rollover rules if you're married. So that means that you're not going to trigger the tax. You can just roll it over, and once that person passes away, then they trigger the tax. But if your assets are ever going up a generation or down a generation, then you're going to trigger tax. So it's important to understand it's really just problem solving when it comes to insurance. What problem do you have, and what problem do you have that you don't even know you have? And that's our job for it as the financial planners that look in there, like,
Wow, I love
by the
it.
way, yeah, by the way, you have this problem. Maybe not now, but it's going to be a problem in 6, 7 years from now. And it's really about understanding your situation. So, what problems do you have, and did you not even realize you have? And then, if we can reverse engineer that, how can we solve that problem with something like a life insurance? So, exactly to Tyson's point, let's say you're someone who has these assets and eventually you're thinking about, when I pass away, what's this going to be worth, and then what's the situation going to be once it triggers the tax when it goes down a generation. The reality is life is very expensive now. I can't even imagine how expensive it's going to be in 20, 30 years from now. So if you're watching this and you have kids and you have assets that you're building, there's a lot of liability there, because while you're building these assets, you probably have a lot of debt currently. You probably have a mortgage, you probably have line of credits, you're leveraging debt to grow, and that's a liability that you need insurance for. On top of that, if everything goes to plan A and everything's successful and everything gets paid off, and you've done an amazing, amazing job, when it goes down a generation, that's also going to trigger tax. And what is the likelihood of your kids having enough liquid cash on hand to pay that bill? Probably unlikely. And even if they need to sell some of these assets to pay the bill for the other assets, what's the liquidity of real estate? Not very great. Because when it comes time, maybe it's a down market, maybe some of those aren't fixed mortgages, so you got penalties you got to pay. On top of that, you got to pay the realtor fee. So you thought you're getting X amount of dollars, but you got to pay all this stuff. Now you're getting this amount of dollars. So there's a lot of things to think about. Whereas our clients that are high net worth, they have wealth, and they want to preserve the wealth, it's a no-brainer. Where there's like, this is simple. Like it pays out. It doesn't get stuck in probate, which is like the courts when you pass away. It's private, so it goes directly to you who want to go to. It's tax free, so they can use that. Simple math, pay off what needs to be paid off, and then they're all good to go. So it's a really good problem solving tool, as I like to say.
Yep.
Yeah, totally. And think about it. Do you really want to pass something down with all that stress to someone? Right? Wouldn't you be down to gift something to someone with all that stress being over? So, yeah, it's much easier, better for that person, and you can deal with it now with less stress. And when you pass it on, it's stress free in a sense. So,
Absolutely.
Absolutely. Yeah, absolutely. And we talked about disability insurance already, but what about critical illness insurance? Do you guys have any kind of experience or different ways to frame critical illness experience or sorry, insurance for anybody?
Yeah, I think critical illness insurance is one of those things that it's not talked about enough and it's underutilized. So it's really unfortunate that the word cancer is so prevalent in our society and it happens so often. And it's not attributed to or linked only to our older generations now. It's happening everywhere. Kids, young adults, middle-aged adults, seniors. Um, you can have cancer at any point in your life now. And let's not talk about why, but it's happening and it's happening a lot. And so what most people don't think about is like in the 80s and 90s, if you had cancer, it was a terminal diagnosis. You have cancer, you have 6 months to live. Now, more and more cancers are super survivable because of the level of care that we have, the early detection, and the different checkpoints that we have in our medical system. So you are likely to survive a lot of different types of cancer. So you're not going to be paid out on your life insurance, but you're likely going to be recovering for 12 to 18 to 24 months before you can go back to work full time. So who picks up that tab? Is your spouse going to get a second job, or you're going to put your kids to work? You sell all your assets in order to stay afloat, or you can have something in place that is critical illness insurance, and it pays out. The big four that it does is cancer, stroke, heart attack, and like organ failure, those kind of things. But it covers 26 different conditions, and it gives you a tax-free lump sum, so that you can cover the cost of whatever it is. And depending on how your planning is set up, that could be a large enough amount to cover 2 years worth of income, which is recommended, or you can do, something else. The the part that Vishal and I have been seeing a lot in the last couple of years is the utilization of critical illness for children. And it's not because you're trying to make money on your children when they become ill, but if your child has to go to children's hospital and they have cancer or they have something else, you're not going to be at work. You're going to be by their bedside in the hospital. You're going to go to every appointment. You're going to fly them to see different doctors. You're not going to be thinking about going to your job. And this is really income replacement for mom and dad so that you can afford to do all of the treatments, be by their bedside, and not think about bills and not think about catching up on other things. And critical illness insurance for children is actually really, really affordable.
Yeah.
wow,
And I think
as you were talking, it like painted a picture in my head. It's horrible to think about, but it's a reality for many parents. And it's
Yeah,
not like there's nothing wrong with my son or there's nothing wrong with me. We don't know exactly what's going to happen in the next minute, right? So,
exactly.
um, yeah,
It,
no, that's
it's
very
wild.
true.
One of the conditions that it covers for children's critical illness that it doesn't really do for adults is we call it like playground injury. So it's acquired brain injury. And so if your kid's on the playground, they bump their head, they're playing sports, they do something, and they've acquired a brain injury, that's one of the
Mm-hmm.
conditions for critical illness. And so,
Wow,
yeah,
I didn't know that.
yeah, and you
Yeah,
just think,
okay.
I don't know how I made it out of childhood. I'm sure I had some acquired brain injuries, but it would have been, nice to know that you can have something like that and take care of your child and be there and not have to think about
Totally.
bills.
100%.
Yeah, and I think another thing, another thing to add to that is, depending if you get it before the age of 3, if I'm not mistaken, Tyson, you can also get autism covered under your critical illness insurance policy. But if you wait a little bit longer, then it's not available. And there's so many different options out there. So we say things like it covers 26. We should actually say it covers up to 26 illnesses because depending what policy you get, there could be 4, there could be like 12. There's a bunch of different things that you can do. But it's important to understand the nuances of all this stuff about what are you trying to cover. And a lot of times, what we notice is it's not even new money that clients are spending. It's reallocating some of the funds. So they're spending the money on this, and instead of that, they're going to allocate some of the money to critical illness insurance because, really, when it comes to myself, like I can just speak because again, we can't give full financial advice. All your situations are different, but I'll just share mine. When I look at my invested portfolio, I wasn't a huge advocate of bonds. Like I'm not a huge bond fan, but instead I was like, I'll just shave out what my portfolio was. I had my portfolio. There was equities, fixed income, bonds, real estate, whatever it may be. The part that was in bonds, I made that a tiny, tiny sliver, and instead I spent that on critical illness because there's options that if I, hopefully I never get ill, and that's the ideal scenario. So best case scenario, I never get ill, and I can just cancel my policy and get my money back, and then that way effectively it was like a low performing bond, but whatever, it's guaranteed income and a forced savings account. But best case scenario, if the worst case happened, is way more money to myself, and then I can keep my RSPs invested, my TFSA invested, real estate invested. I don't have to take on debt, all that kind of stuff. And that's really about framing, like how you want to look at it is where's your money currently going, and how can we reallocate it to solve a lot of your problems? Because we can't just snap your fingers as your financial planners and be like, all right, so you need another $200 a month in insurance to solve these problems. So let's just create $200 a month. That's not possible. But instead, what we want to do is look at, where's your money coming from? Where's it going? What's left over? What problems do you need to solve? And then how can we do that? And, we can reallocate some money and remake portfolios and things of that type to solve all your problems. And an example would just be, I just got a referral yesterday from another business partner of ours. And she has a client that has one insurance policy, which is a permanent universal life policy. Had it for a few years, but she has no disability, she has no critical illness, and she needs more term insurance than anything else. But the advisor that she was working with was just like, yeah, get some permanent insurance, that solves all your problems and you're good. But instead, we want to rebalance that portfolio. It's as if, Kalinka came to us and she's like, I got all my money in Microsoft only. Yeah, I invest in my TFSA, but everything goes in Microsoft all the time. It's like, well, we should probably rebalance your portfolio, but people don't see it from your insurance portfolio should be the same because you should have a balanced insurance portfolio because I think Kalinka just said it as well. You don't know what tomorrow is. So you want to make sure that no
Yeah.
matter what happens, you have a plan in place to help you so you can continue to build your wealth over time and then also protect that wealth and pass it to the next generation if that's what you want without having a huge problem to solve. Or you can donate to charity, you can do whatever you want with it. But it's important that you get insurance while you can get insurance because once you're unhealthy, that's it. You can't go back and get insurance. There's a certain point that it's too late and you're not insurable anymore, which is a very, very difficult position to be in because we do get clients like that sometimes that I regret it. Someone told me to get insurance 6 years ago. I waited on it and now what can I do? And the answer sometimes is nothing. There's high risk insurance companies that will be like, yeah, we'll take you on, but we'll charge you so much money, and we just run the numbers. Like honestly, it makes more sense to self fund at this point, but that's just never a situation you want to be in.
Yeah. No,
Yeah,
you
and
hit on a
just
couple of good points.
sorry,
I'm
Tyson.
sorry. Go ahead, Klinka.
That's okay. I think another a percentage of people to take wrong advice, right? So my neighbor has this, or someone told me to do this because that's exactly what they're doing. And it goes for mortgage as well. Let's look at the big picture. What are your priorities? What's important to you? And then based on that, we build a plan, a portfolio, or we choose the products that speak to your goals, to exactly where you are and what your life looks like, right? So I think that's also another strong point of like taking wrong advice and copying paste because someone else did it, and it's not really like that.
You're exactly right. My clients that are trades guys are the worst. They gossip on the job site and they talk about stocks and how much money they're making. No one ever talks about how much money they lose. and they're my gossip guys, and that's just how it is. Vishal hit on a lot of really good points, and I think a couple of them is number one, what a good financial team does for a client is we're going to reorder the way that the shells are in your life. We're just going to change the order of operations so that we maximize the dollars that you have to do all the things that should be done. One in a presentation Vishal and I did recently, we talked about if you're 35 years old and you take $10,000 out of your retirement, that is equivalent to $100,000 at retirement. So you think, oh, I'm just going to take $10,000 out. I'm 35 years old. I'm going to cover my costs, pay my bills, and do those kind of things and survive. You're robbing yourself of $100,000 opportunity or more in retirement. And so it's like the future, the value of money that we have to look at, and that is a perfect example of where a disability or a critical illness insurance could give you that income to preserve you for that time period when you get back on your feet, and then you're not robbing your future money and your retirement, and you don't even know it because that's future money. You don't see the impact that it's going to have, and so that's how we take care of today and also defend you from tomorrow.
Absolutely. So in closing, I think we love to do at the end of this is just give you as the audience some direct paths to solve all the things that we talked about today. So you could be listening to this like, damn, I'm driving to work right now. Sorry. Like, damn, I'm driving to work right now and I got all these things I gotta take care of. What do I do? What's the next step? So what we recommend is just book a meeting with whoever your financial planner or your insurance person is. And if you don't have one, or if you want a second opinion, that's what we're there for. You can contact us at info@portfolioplanning.ca and just book a meeting and just have a conversation. Like, hey, this is kind of what's going on now. Am I missing something or something better that's out there? You don't know what you don't know. And that's okay. But what's not okay is not taking steps to solve those problems for yourself. After all the hours you put in for work, after all the stuff you go through on a day-to-day basis, you deserve at least the opportunity to make sure that you get the best thing for yourself and for your family. So if you're listening to this, make sure you book a meeting with whoever your professionals are. And if you don't have one or want a second opinion, we'll provide that for you. info@portfolioplanning.ca, and we can talk about your insurance, your investments, whatever it may be, and just make sure that you have the best of the best. And when we talk about high net worth individuals, which a majority of our clients are in that space, really the biggest differentiator of high net worth is that they have the thought process and the resources to get professional help with their team of professionals, accountants, lawyers, financial planners, so on and so forth. But it's 2024 now. It's not 2014. So with automation, with AI, with tech stacks, it's a lot more feasible for professionals, the same professionals, to work with people who aren't able to pay them $5,000 a month in retainers or whatever it was back in the day. So the opportunity to get the answers that you need has never been better, but just make sure you get it from proper sources, because technology and social media can be a great thing or a horrible thing. Job sites can be a great thing or a horrible thing. It's good to kind of get an idea, but when it comes to what it actually means for your family and yourself, make sure you book a meeting with a professional that actually has a track record of doing good work. And the good thing is, once you set it, you can kind of forget it. You don't need to redo it every single year, redo your insurance every single year. You can get a good portfolio in place, and then it's off your plate, and you don't have to worry about it on an annual basis. It's off your to-do list, and you're good. Any closing thoughts you guys have before we wrap up here, and Clinton can go back to living in Brazil?
Yeah, I'd like to be a snowbird.
It's not that hard. It's not that hard. One thing that I'll quickly add, get in touch with us. What I like to say is that we're free. So give us a call and book a meeting with us. Ask away your questions. There's no such thing as a wrong question, right? So I like what Vishal said, and that's one of my favorite lines. You don't know what you don't know. So ask away, get in touch with us. If we don't know, we have, of course, a network of partners who can absolutely help you, and we're here.
Love it. Amazing. Thank you, Kalinka, for your time. Thank you, Tyson. And if you're watching this, make sure you subscribe and like. It helps our channel. It helps us, get the ROI needed to continue to do this in a bigger way and a bigger platform and things of that type. So Any question you have, you can email us, comment, whatever. I don't know where you're going to be watching this. We have it purposed across all different platforms. So get in touch if you need anything. And besides that, make sure you stay tuned because next week we're going to be talking about a different financial topic and something that'll bring value to your life. So thank you, everyone.